Hey, Jenny Kassan here, coming to you live from Austin, Texas, and I'm here to lay down the law about all the cool things you need to know about getting your business funded and making investments and doing it in a way that really fits your goals and values and lets you stay in alignment with the law. So I'm here in Austin, Texas at a conference called Women in Money, Making Money Moves That Matter. And the conference just ended. I'm back in my hotel room. And some things that happened at the conference inspired me to talk about the venture capital model. So this was a conference that was talking about how we can move our money as women into investing that really makes the world a better place and supports women and girls in lots of different ways. And one example that was given was investing in venture capital. And I had some concerns because I personally believe that the venture capital model is so flawed that even if more venture capital money was invested in women-run and led companies, that it wouldn't really make the world a better place. So I decided to go ahead and share the top 10 problems with the venture capital model, and then I'm going to talk about which of those issues could maybe be fixed by changing who is in the game, but which of those issues cannot really be fixed without completely throwing away the model. So here is Jenny's top 10 list of what is wrong with the venture capital model. All right, so I have to look at my notes. So number one, and this one, you hear about this one a lot, who gets funded? So if you've ever heard about venture capital funding and who gets venture funding, you've probably heard that maybe about 2% of the funding goes to companies led by women. It's even less for women of color. A woman of color probably has a better chance of getting hit by lightning than getting venture funding. And people of color, people that maybe are older, come from non-traditional, backgrounds that, non-privileged backgrounds, let's say, have a really hard time getting that funding. So the funding is going to a very small group of people, small in terms of how representative they are of the general population. So super privileged, generally fairly young, white men who have gone to, Harvard and Stanford and MIT. Basically, they're getting most of the money. And not only that, but to get venture capital funding, generally you have to first have what they call a friends and family round, which means that you somehow find people that'll give you, a few $100,000 when you're first starting out, because venture funding doesn't come until you've already raised what they call a friends and family round. So if you have trouble finding friends and family that have the kind of money to fund you in an early stage, then ever being able to get venture capital is tough. So also, and I'm still on my number one here, I know I'm gonna have to speed it up, but this is a big one. So venture capital is a certain type of investing, and almost everyone who knows anything about it would agree that probably 99% of companies, or probably a lot more than 99%, 99.9% of companies in our country just are not a good fit for venture capital. So even if you're a white male who went to Stanford and, comes from a wealthy background, unless your company has the potential to grow really huge, like an Airbnb or an Uber, your company probably isn't venture backable. So that's number one, is just very few people get funded, and it's mostly younger, white, privileged men. Number two, who controls the money? So venture capital investment decisions are made by professional venture capitalists who manage the money. And I was told today that 99% of the people who are in real decision-making authority in venture capital funds are white men. So 99% of the money is being controlled by white men. And of course, that's part of why so much of the funding goes to white men, because people just tend to be a little more comfortable funding people who remind them of themselves. So because that money is controlled by, you know, a group of people who are not really representative of our overall population, sometimes it can really skew what gets funded, which is that's actually a different number 6 on my list, but I'll get to that in a second. So number 2 is that the money is controlled only pretty much by white men, privileged white men. Number 3, part of the venture capital model for most venture capital investing is the idea that you make big bets on highly risky companies that, you know, could make it really big, like the next Uber, the next Airbnb, or could just not really ever get anywhere. And so, you know, they talk about like singles, doubles, triples, and home runs. And so, most venture capitalists will say that we want at least 1 out of 10 of our investments to be a home run, a company that's going to really, you know, at least increase in value by 10 times, be sold to another company at a really high value. And so we don't even care that much what happens to the other 9, as long as at least 1 out of 10 does that. Like 1 out of 10 is like the next Uber or Airbnb. And so the problem with that is that the attitude is sort of like, you know, if a company starts to look like it's not going to be that 1 out of 10 in your portfolio, you start to neglect it and you don't continue to support it. So the failure of 9 out of 10 investees is built into the model, which is really quite a destructive way of allocating money. You know, those 9 companies might have had, you know, some really great things going for them, but if they can't meet those really high growth expectations, they're just kind of allowed to die, and, you know, a lot of jobs are lost, and valuable, you know, ideas are lost. Okay, so that was number 3. Number 4, the compensation model of venture capital is, you know, not the most fair thing in the world, I would say, for the investors. So when the people who manage venture capital funds, generally they get to take every year 2% of the assets under management. That's quite high, you know, so if that's way more than you get, even if you just put your money into the bank, you're getting like a 1% return maybe. Whereas if you put your money into a venture capital fund, you're giving up 2% of your money automatically every year. To, you know, on the assumption that these venture capitalists are so brilliant and so skilled that they're going to get you this huge return. And then on top of that 2% that they make every year, they also get 20% of the increase in value beyond the initial investment. That comes if the fund does well. So the venture capitalists are highly, highly compensated. Another problem with that compensation model is that you have to have a very large fund for the people who manage the fund to be reasonably compensated. So I know this because I did a $1.1 million fund with some of my colleagues, and, you know, even if we had taken 2% out of it, which actually we're taking 5%. It's still not, we all had to do the work as volunteers because it just wasn't enough money to cover our costs. And so unless you have at least maybe like a $50 million fund, it just doesn't really, the economics don't add up. So the compensation model makes it, you know, pretty difficult for people who aren't incredibly well connected with super wealthy institutional investors to even start an investment fund. So it's not, in some ways it's bad for the investors because they're having to give up a big chunk of their money to pay the fees, but at the same time it's also bad for fund managers, because unless fund managers are mostly incredibly like well-connected people, because otherwise there's no way they can raise a big enough fund to, you know, to make it worth, economically make sense. Okay, number 5. So, number five is the fact that most venture capital funds don't make it. They actually fail. They don't make any returns for their investors. So, according to the Kauffman Foundation, most venture capital funds return zero to negative to their investors. So, even though venture capital is held up as this really cool thing that we need to fund like the next most innovative things that are happening in the world, most of them actually don't do a good job. They don't end up picking winners. So, it just in terms of pure, is it a good investment or not? On average, it's not. Number six, what gets funded? So this takes me back to what I was saying before about how when 99% of the people who control the money are all a very, very specific type of person. People who mostly live in New York, Boston, or the Silicon Valley, or San Francisco, who are privileged white men. The kinds of things that get funded are things that have to do with food delivery. There's like tons of startups that have raised millions and billions of dollars for food delivery, because guess what? Tech guys get hungry and they want food. But what about our world's biggest problems? Are solutions to those problems getting funded? Not so much. So sadly, a lot of capital is being allocated to things that, yes, it's nice to be able to get food delivered to you, but, wouldn't it be nice if some of that capital was allocated to entrepreneurs who were, focused on like truly solving some of our world's biggest problems? And unfortunately, those generally are not what's getting funded by these types of investments. Number seven is that when you take venture capital money as an entrepreneur, you will be giving up control of your company. The venture capitalist basically becomes your boss. And often the founder gets fired from their own company. In fact, I hate to say it, but if you're a female founder, it's way more likely you're going to get fired from your own company when you take this kind of money, because the few female founders that do get venture capital, often the VC kind of doesn't see that female founder as their idea of who is a strong manager of the company or a strong CEO. So, so if you had a dream to build a company and do certain things with it, and you take this money, chances are you could easily get fired from your own company. Number eight. The model of venture capital investing is that it concentrates wealth in fewer and fewer hands. So as many people have talked about, our whole finance system is really set up in such a way where the rich get richer. And venture capital is totally that, It's venture capital investing is only open to the most wealthy people, families, institutions, and so of course, you could argue like it actually doesn't make the rich richer, because most of the investors never make money, as I was saying earlier. But to the extent your venture capital investment does well, and you have that Uber, that Lyft, that Airbnb or whatever, the people who get rich off of those unicorn companies that do make it, according to the standards of what is a success under venture capital investing, it's the rich getting richer with it. And other stakeholders in the company, like the workers, the customers, the community that is affected by the company, effects on the planet, like none of those things are necessarily going to benefit when a company does well under this model. The number one goal under this model is to make the investors as rich as possible, as quickly as possible. Number nine. So the model of venture capital investing is that an investment is considered a success when there's an exit or a liquidity event. And a liquidity event is the name for what happens when a company generally is going to be sold to another larger company. So, maybe you have a tech startup and Amazon or Yahoo like learned about you, and they really liked what you were doing, and they said, we're going to buy your company. And that's considered a success. If you don't have an exit like that, you have failed according to the venture capital model, because that is the whole model. So what do you have to do if your goal is to sell your company as quickly as possible to a larger multinational corporation? What do you have to do to be an attractive acquisition target? I believe that the things you have to do can really distort your company. So it's very well known that a venture-backed company is going to spend massive amounts of money on customer acquisition. They'll just bombard every channel with as much marketing as they can. If it's a B2C company, they'll do whatever it takes to achieve those growth goals so that they can become an attractive acquisition target. And sometimes the things they need to do are not consistent with actually making a great company that customers love. It's kind of this short-term thing of like pump it up on steroids as quickly as possible so someone will buy it. And often when the reason the big multinational company buys your company isn't necessarily because they think you're such a great company and they want to help you grow. It's because they're like, oh, you're a competitor and we're going to buy you and shut you down. Or, oh, we really like your team, so we're going to buy you and just shut your company down, but bring your team on and have them come work for us. So that whole idea that the exit is the goal can lead to a lot of distortion and waste of money, because you just have to spend so much on customer acquisition to show that you can dominate a market at any cost. A lot of venture-backed companies don't become profitable, like Airbnb and WeWork and all of them, because it would be bad for them to make a profit, because they're just trying to spend as much money as possible on customer acquisition. So they're actually encouraged to lose money because they're investing in growth at any cost. So I think that's distorting. I think a company should work towards profitability at some point. I mean, we have publicly traded companies now where nobody knows how they're ever going to break even. And somehow they're valued at billions of dollars, and we don't even know if they're ever going to be profitable. Okay, number 10. So this is a related one, and that is, okay, so let's say you said, okay, an exit isn't a bad thing. Like, an exit means that I've sold my company to a larger company, so they're gonna have resources that are gonna allow my company to grow in a way that I couldn't have done on my own. I think about a lot of beverage companies, like their dream is to be acquired by Coca-Cola. And of course, many of my formerly favorite beverage companies have been acquired by Coca-Cola. And it's like, well, with the resources of Coca-Cola behind us, just look how successful we can be, So there's this idea that an exit can actually be beneficial to a company because resources are brought to the table that could never be there without the acquisition by the multinational corporation. However, I believe, and I don't know, it would be fun to kind of study this, I'm sure someone has, but I believe that most acquisitions result in a negative outcome for the stakeholders of the companies, whether the customers, the workers. So I'll just give you one of my favorite examples, and that is Ben & Jerry's ice. Sorry, I just got a call. When I was back in the early 90s, I was living on the East Coast, and we would go to Vermont and we would buy Ben & Jerry's ice cream, and it was so delicious and so amazing. And Ben & Jerry's, they were so socially responsible. They would, build these scoop shops in inner cities, not to make money, but just to create good jobs in inner cities. And then they were acquired by a big giant multinational corporation called Unilever. I think the ice cream tastes like crap now. It's so bad. I buy it every now and then because I'm like, really? Is it really that bad? I keep trying to convince myself it couldn't be as bad as I think it is. But it is, right? So I don't know if you agree with me, but I mean, if you tasted it in the 90s compared to today, it's crap. And that's because, it's owned by a big giant multinational corporation and they have to put profits above all else. So that means they don't put the high quality ingredients in. And guess what? They no longer have inner city scoop shops. So, oh, and by the way, my husband has worked for some companies that have been acquired, some startups that have been acquired, and every time, like, it kind of destroyed the company because the culture didn't fit. The acquiring company didn't really know what to do with that company. It took them forever to try to integrate them in, and it didn't work very well, and people left, and sometimes there are lawsuits. I just think the whole thing is a mess. Okay, so those are my top 10 things that I hate about venture capital. Now, so there were these women at the conference that I was at just now who said, well, we can change venture capital because we're different. We're going to do things differently. And we believe that if more women get involved in venture capital, not just on the side of the people who are making the investment decisions, but also the investors, what we call limited partners. We need more women making the investments. And then, of course, then that's going to lead to more investments in women-led companies. So I was thinking about it and I was like, okay, maybe it's true that of these 10 issues, some of them probably could be improved. So I think numbers 1 through 5 could be potentially fixed if more women and socially conscious people, and I shouldn't assume that all women are socially conscious, but if more diverse people got involved in venture capital investing and people who were more conscious about the need to invest in things that are making the world a better place for more people. So items 1 through 5, I think could get better. So number 1, who gets funded? Yes, maybe more non-white men would get funded. And there's a good reason why that would happen because there's lots of evidence that actually women-led companies do perform better. So it wouldn't be difficult if women were more involved in the investment decisions. It wouldn't be super difficult to move more money into women founders because there's no argument as to whether women founders generally are good at running companies. There's tons of proof that they are. So, in fact, better than men on average. So who gets funded? Yes, that could change. Number 2, who controls the money? Yes, that could change. Wouldn't that be nice if more of the investors and money managers were women? And that could lead to more women getting more wealth because if they're investing in these funds and things are going well, they're going to get more wealth. Number 3, the whole thing about the model where only 1 out of 10 will make it. These women that were at this conference today were saying, we don't really have that attitude. We want they said, it's like a parent, you don't want only 1 out of your 10 children to make it. You want all your children to make it. So they have the attitude that they're going to work really hard to support all of their investees, even if they don't all become the home runs, even if they're only like doubles and triples. That's cool. I like that because, it's a waste of resources, like I was saying before, to just focus on, sorry, I got another phone call, to just focus on the one that's the home run and kind of leave the others by the wayside and be like, oh, well, you didn't make it, so too bad, you're out of here. So that's cool. Number 4, the compensation model. The compensation model could change. It's not set in stone, so that could be changed to something that's better. I don't know what that would be, but that could be changed. Number 5, the fact that on average the investments aren't actually doing well, that people are not making any financial return at all on venture capital, that could change if we have some really awesome investors who are investing in female-led companies. Maybe the returns on the investments will actually be better because, like I said, there's tons of evidence that women-led companies are actually perform better. Okay, so those are first 5 things out of 10 things that actually could be fixed by just diversifying the people that are participating in the venture capital world. But The other things I don't think are as easy to fix. So number 6, what gets funded? So while it is true that if we had more diverse people involved in the venture capital industry, there would probably be more things funded that benefit women. So for people always joke around about how like, oh, if there were more women in venture capital, we'd have so many things that would help with menopause and, all kinds of things that women problems, and that's cool. That would be good, right? I mean, we don't probably need yet another food delivery app. Maybe there would be some things funded that are maybe a little bit more important to more different kinds of people in our society. However, would the truly world-changing, truly problem-solving companies get funded? Maybe not, because they might not be venture backable, because they might not have the potential to be bought by a giant multinational corporation. Because if you're truly doing something world-changing, you may not have that ability to dominate the market in the way that venture capitalists want you to. You might need to go a little slower and be more have more sustainable growth and not like throw all the money at marketing and all that stuff. So I question whether truly positively impacted companies that have a truly positive impact would get funded, even if we had more diverse people involved in venture capital. Number 7, the idea that founders have to give up control and that female founders are more likely to get fired from their own companies. That could change maybe if more women were involved in VC. I mean, I think women VCs are still going to want founders to give up control, but they may be less likely to fire female founders because they would maybe have more belief that the female founders are actually good at running their companies. So that could change. But the last 3 items, 8, 9, and 10, are not fixable. I don't care how many women, how many people of color we have in the VC world. These things are inherent to the VC model and cannot be fixed. And I believe these 3 things are the things that make VC just something we should no longer have at all, no matter how diverse it is. So those things are concentrating wealth in fewer and fewer hands, requiring the fast growth at any cost, leading to an exit, and of course, just what happens to companies when they have that exit. I mean, do we want to be supporting a model whose sole goal is to get these companies bought by multinational corporations? I mean, are we happy with the type of with the way multinational corporations are running our economy right now? Are we happy with the types of products they're bringing to us? There's expose after expose about what these companies do to cut corners, to addict us to opioids, to, keep cutting back on quality ingredients to reduce the cost by 1/10 of 1 cent so that they can make more profits for their investors. That to me just makes the whole model completely unacceptable and bad for our world. Therefore, I do not support efforts to get more women as limited partners in venture capital funds or as venture capital partners managing the money. So that was my very long soapbox statement on this topic. I would so love to hear what other people think. I know this will hurt a lot of people's feelings because there are people who, are devoting their lives to diversifying the VC landscape and ecosystem. I just personally I can't get behind it. I just can't. All right, have a good rest of your day. I will